Now, we use a lot of wide wing butterflies, and so these are used because they're going to give us that wider profit zone. They're also going to be always, we can structure for defined risk, great for hedging, used for targeted directional swing trades. So most of the trades we do are kind of what are kind of called swing trades. They can be trades that could last from 1 to 2 weeks kind of thing, maybe 3 weeks. So kind of swing trades are kind of cycle trades based on a daily price movements. So they're also used for directional pinning trades. So when we think there's a certain strike, maybe at expiration, a certain company or stock may go out at, that's what we call a pinning trade. Really great for high volatility markets, because what we're doing in a high volatility market, we can reduce our risk, but also when implied volatility is higher, we're going to get more premium from the selling component of the butterfly. So, they're a combination of vertical debit and credit spreads. So we get a bigger premium when high volatility markets happen. And they're great for trading at high price stocks. I'll show you a really good example there. Trade duration 1 day to 2 weeks is kind of the sweet spot, kind of that we look for. Always going to be positive, no time decay. Returns of 2 to 1, 10 to 1, and higher. So of all the different option spreads, the butterfly will offer you the biggest return on capital of any potential spread or any spread that's out there on options. So here's an example of a short that we did on QQQ using a wide wing put butterfly, $1,000 wide. So it's a $10 wide spread, or per option contract that would be $1,000 wide. So the trade setup here, QQQ was trading at around 314 right in here, and we were looking for the downside target move down to about 304, which was coming in here. This was like the 50 simple moving average and some price action support, and right there coming in right into that that area where that moving average was. So we were targeting 304. So that was going to be our body of the butterfly based on that target. So we set this butterfly up $10 wide. So we took at the time it was trading around 314.60. So we bought the 314 put, sold the 304 put, our target. All right, $10 wide on that side of the spread. Then we sold the 304, bought the 3294, $10 wide. So balanced butterfly. So $10 or $1,000 per option spread, butterfly, and then the cost of the trade was $2.10 was the debit cost, so $210. So the potential profit was going to be $790 at expiration if it went out at our top of the butterfly. So that would be a 376% return, or risking $1 to make $3.76. So if you had, let's say, shorted the shares and you made that profit, went down and you made the 1060 per share, went to that 314 or 304, that would have been a 3.36% return. So the returns on these things are really incredible. So you can see the difference here just from shares to doing the options. But that's a great return. But from time to time you're going to get even potentially greater returns than that. So I'll show you some examples here of that how that happens. So here's the butterfly. You can see it's a very wide body butterfly, and again it's doing the 314 put. So we're long that 314 put here. Then we shorted the 304 put here. Okay. Now we can leg in or do it all at once. Most of the time we'll do it all at once, and then we're selling that 304 put again and buying this 294 put down here. Okay, so we've got this put butterfly, and you can see that profit zone in there. Okay, now this was going out right there, so it wasn't perfect, but it's close enough because you've got that big zone of profit. So this spread, went from on the 23rd at 210, went from 210 or $210. So if you did one contract, it went up to 782. So that's a return, per spread of $572, and on your risk of 210, that's a return of $272. Versus if you'd done the shares, you would have been 3.6% return. So huge advantage again being that taking advantage of the time decay, the volatility crush, low defined risk, high return on capital type trade. So that little black speck in there is what's still left of potential profit, but still not a bad profit on that. Going out at 306 right here. So that's a kind of an example of a wide wing butterfly